One of the legends in the investing space warns of a 0% return on the stock market for years to come. Warren Buffett's right-hand man, Charlie Munger, has outperformed the market by almost 2,000% since 1986. In an annual Daily Journals conference, Munger spoke regarding the serious issues he sees in the economy and financial markets. In this video, we'll talk about how the investment legend is preparing his portfolio to drastically outperform the market in the coming years. We have to analyze the macroeconomic environment in order to understand how Munger plans to make large sums of money from the economy. Consumer spending came to a halt as a result of COVID-19, and the government had to step in to help. There are two sorts of unemployment. U3 unemployment is a database that keeps track of all unemployed persons who are looking for work. In addition, there is U6 unemployment, which is a larger metric that includes discouraged workers and part-time workers. Unemployment among U3s surpassed 14% in April 2020, while unemployment among U6 surpassed 22%. This is a significant sum, as nearly 1 in every 4 people was unemployed or underemployed. Congress issued stimulus checks to citizens and provided state and local governments with various lending and grant opportunities. COVID relief monies were also supplied through these checks, which aided companies. In addition, the Federal Reserve cut interest rates, making borrowing less expensive. The target interest rate dropped from 1.5% at the end of February 2020 to 0.06% in April 2020. That rate is currently 0.08%, but everyone expects it to rise. These policies are preparing the ground for a devastating economic downturn. While the Federal Reserve cut interest rates, it increased its purchases of government bonds in the market, known as quantitative easing. During the pandemic, the Federal Reserve purchased in excess of $4 trillion of debt, which had the effect of pushing money out into the economy. Inflation was finally influenced by the law of supply and demand. More money in everyone's hands increased demand for commodities, but that alone was not enough to cause the current inflation. Munger is aware of the rise in M2 money, inflation, and the resulting consequences, an asset bubble. The problems associated with the supply chain have also worsened the situation. Unlike before, there are fewer things in stores and the prices of certain items have increased. The inability to get things off the boats and into the marketplace is to blame for the majority of this. Though issues existed prior to COVID, it worsened during the pandemic. The point is that all of this pressure leads to a shortage of goods. Consumer prices have reached new highs as a result of this pressure, which has been exacerbated by the expansion of the money supply. The Consumer Price Index has increased to a 7.5% annual increase. An important relationship to understand here is that inflation and interest rates are linked. In the 1980s, inflation soared to unprecedented heights. Fed Chairman Paul Volcker raised rates numerous times to get ahead of inflation. Charlie Munger also said this could lead to new troubles and could be worse than those we saw in the late 70s and 80s. When adjusted for inflation, the market returned 0% from 1965 to 1980. Munger sees a similar conclusion, predicting that the market would have negative returns over the following decade.
There's never been anything quite like what we're doing now, and we do know from what's happened in other nations, if you try and print too much money, it eventually causes terrible trouble. And we are closer to terrible trouble than we've been in the past, but it may still be a long way off. I certainly hope so.
The first outcome we discussed was a decade of high inflation, and the stock market's inflation-adjusted returns are modest. There's also the possibility of a second conclusion, which Munger is considerably more concerned about. The world's largest future exchange, CME Group, recently published a report that reviews the market expectations and how accurately investors tend to forecast rate hikes. Currently, the expectations are for 4 to 6 Fed rate hikes in 2022 and 2 to 3 more in 2023. These increases are usually 25 basis points each. A basis point is equal to 0.01%. As a result, a 25 basis point increase equals a 0.25% rise. So a 25 basis point increase from 2% to 2.25% would result in a rate of 2.25%. The target interest rate is expected to wind up at 1.625% compared to 0.08% today. The Federal Reserve is cutting asset purchases, specifically government bonds, in addition to raising interest rates. Such an action has the effect of lowering the available supply money. In January 2022, the Fed reduced purchases to $60 billion, which was down $30 billion from December and down $60 billion from November. It's worth noting that the Fed continues to buy bonds, thereby increasing the supply of money in the economy and artificially inflating the demand for treasuries. As the Fed decreases its purchases to crucial price and yield levels, there would have to be an equal amount of fresh demand stepping in. This increased demand would have to compensate for the Fed's lack of bond purchases. To have a net zero effect on the market, treasuries would have to find outside investors willing to add $60 billion to $100 billion to their portfolios each month. That is extremely unlikely. Thus, tapering will also result in lower bond prices. Bond yields and bond prices are inversely correlated, so that would equate to higher U.S. Treasury yields. The tapering of bonds will also have a substantial impact on bond yields and therefore interest rates as well. Munger is cautious to predict that the low-rate asset bubble would burst when interest rates rise. He believes the lower prices were implemented as a last resort during the COVID pandemic's early stages. What should investors do now that we know the economy is in serious trouble?
Conventional economic theory argues that excessive monetary and fiscal stimulus over the last 2 years has triggered the highest inflation in 40 years. Do you broadly agree with this thesis? And more importantly, do you think there will be a high economic price to pay as the Fed attempts to bring inflation back under control? I guess the reasons for it.
Well, the first part, I agree with it. We've done something pretty extreme, and we don't know how bad the troubles will be, whether we're going to be like Japan or something a lot worse. And what makes life interesting is we don't know how it's going to work out. I think we do know we're flirting with serious trouble. I think we also know that some of our earlier fears were overblown.
So now that we know that the economy is in serious trouble, what should investors do? Munger is bearish on commercial property and offices, but he recommends owning stocks in apartment buildings.
The Mungers have Berkshire stock, Costco stock, Chinese stocks through Lilu, a little bit of Daily Journal stock, and a bunch of apartment houses. Do I think that's perfect? No. Do I think it's okay? Yes. I think the great lesson from the Mungers is you don't need all this damn diversification. That's plenty of. You're lucky if you've got 4 good assets. I think the finance professors and that sell the idea that perfect diversification is professional investment. If you're trying to do better than average, you're lucky if you have 4 things to buy. And to ask for 20 is really asking for egg in your beer. It's very few people can have enough brains to get 20 good investments.
Diversification beyond 4 to 6 investments, according to Munger, is not a smart idea. While he does not provide a precise figure, he claims that too much diversification produces declining rewards. Markowitz's modern portfolio theory, or MMT, is at the heart of his argument. According to this argument, adding a stock to a portfolio lowers portfolio volatility. The fluctuations get fewer and less as you add additional equities. With 10 stocks, each stock would be 10% of the portfolio. With 5 stocks, each stock would be 20%. And with 100 stocks, each stock would be 1%. With 100 stocks, a single stock doubling would have a negligible effect. However, with 5 stocks, doubling one of them would have a much greater impact. According to Munger, the current market is ripe for gambling and speculation. He used the SPAC space as an example, which generates funds before receiving investments.
Well, certainly the great short squeeze in GameStop was wretched excess. Certainly the Bitcoin thing is wretched excess. I would argue that venture capital is throwing too much money too fast and there's a considerable wretched excess in venture capital and other forms of private equity. And so we have a stock market which some people use like a gambling parlor. And the transactions of the people who love the gambling parlor aspect of the business and those who want to make long-term investments to take care of their old age and so forth. I mean, you muddle it in one market and it goes out of control because the stock market becomes an ideal gambling parlor activity. I don't think that ought to have been allowed either. If I were the dictator of the world, I would have some kind of a tax on short-term gains that made the stock market very much less liquid and drove out this marriage of gambling parlor and legitimate capital development of the country. It's not a good marriage, and I think we need a divorce.
Other signs that Munger points to, besides the 850 SPACs, include the great short squeeze and high multiple valuations. The S&P 500 is currently trading at 20 times forward PE based on Bloomberg's estimates consensus earnings. While this is down from the recent peak of 27 times in August 2021, such frothiness has never been seen in 20 years. Similarly, the Nasdaq has declined to a 28 times Bloomberg consensus for PE, also down from its recent December peak of 40 times. These levels have not been seen since 2003. Diversification outside the US could be a positive thing given the current macroeconomic situation. Munger has invested in China through stocks such as BYD and Alibaba. BYD has been one of Munger's best picks of all time, which has also led to his more recent investment in Alibaba. Charlie Munger also explained why he invested in China despite the major risk. He believes that while these risks exist, the value is substantially better in China's financial market when compared to the US. Munger went on to say that there are negative tensions between China and the United States, and that they would continue to exist since the United States does not appear to realize that the differences in government are appropriate. While China's system and policies would have failed in the United States, they were necessary in China.
Well, the Chinese government is worrying all the capitalists in the world way more than it used to. And of course, we don't like that. And we wish that China and the United States got along better. And if you stop to think about it, think of how massively stupid both China and the United States have been to allow the existing tensions to arise. What bad is ever going to happen to China or the United States if we two are close? If we make good friends out of the Chinese and vice versa, who in the hell is ever going to bother us? Of course we should make friends with China. And of course we should learn to get along with people who have a different system of government. We like our government because we're used to it and it has advantages of personal freedom. China could never have handled its life with a government like ours. They wouldn't be in the position they're in. They had to prevent 500 million or 600 million people from being born in China. They just measured the women's menstrual periods when they came to work and aborted those who weren't allowed to have children. You can't do that in the United States, and it really needed doing in China. And so they did what they had to do using their methods, and I don't think we should be criticizing China, which has terrible problems because they're not just like the United States. They do some things better than we do. They should like us and we should like them. So I think nothing is crazier than people who foment resentments on either side of that one.
Aside from Munger, some top investors, including Ray Dalio, venture capital powerhouse, Sequoia Capital, and Munish Pabria, have continued to invest in China. Munger believes that the US and China will continue to maintain stable relations, which decreases the risk. Inflationary pressures, Fed tightening, supply chain difficulties, and overvalued valuations and speculation have put the markets in risky territory. Munger's portfolio has been adjusted to survive these macroeconomic trends by allocating funds to strong companies. Bank of America, Wells Fargo, Alibaba, US Bank, and POSCO make up the majority of his holdings. Munger isn't a big fan of diversification, so he's focused on these companies as his long-term winners. Now, what do you think of Munger's plan? Let me know if you agree. Comment down below. If you enjoyed this video, please hit the like button and subscribe. This is your Top Tech and Trades channel. Thanks for watching, and I'll see you in the next video.